Only three joined, others they're going to join. Okay, regarding the old question papers, since now the exams are computer based exams, the question papers are not available and they will not be available on the website till FR exam. So from FR is F7, I think. From F7, these papers are available on the website. That's one thing. Another thing is you you can download the exam kit from the from LMS. So I don't think you are added there in LMS. You should be, I mean, they would be adding because the names and other details also have to be added. Your attendance is marked there in LMS, etc. But if you want it before that, if you want to have the copy of LMS, I can also post it in WhatsApp group. If I'll just share my number here in the chat. One of you just send a message, hi or something. I'll put this PDF file, exam kit, with wherein the question, exam type questions are there in that exam kit. For every paper you will have, but since your name, your college name is not yet added in LMS, I will share that PDF with you. Okay. I just make a note of my number. Usually we form WhatsApp groups, but since this is an exemption paper and it's only a 20 hours training, so um, because so then usually we don't share so much of material and all. And for other papers, for every college, I mean, WhatsApp group is created. All the students are there in that faculty. Um, we would be there and then share material or any other thing, queries, exam related doubts, etc. All those things are clarified in the group. Any one of you just send a message after the class, hi or something. I'll put the PDF file in the WhatsApp. I mean, to your WhatsApp account. That is all what is available. Exam question papers are not available because now it is all computer based exams, so those papers are not available. Okay, let's start. The other day, before we ended the class, we did start with this topic called as capital structure and finance cost. Okay, so the discussion also took place. What are the, broadly speaking, what are the different types of capital? There are two types of capital. One is capital raised from the owners called as equity, and capital raised from outsiders is called as debt. So the attributes also we did look into that. In terms of cost, in terms of cost, in terms of risk, when we looked into, each one of them had their own have their own attributes. Debt is a cheaper form of capital, but the risk on that is higher. But equity is a costlier source of capital, but the risk is low on that. So an equal proportion of capital should be raised and invested in the business. So under equity, then again, see what would be there under equity. Equity has, it's a kind of an umbrella term under which there are many items. So under equity, the category of equity, we see that the share capital that is raised, any premium amount that is collected on issue of share capital would be there. All undistributed profits. Now profits belong to the shareholders. Profits belong to the shareholders, but out of that, the one portion of profits is paid to the preference shareholders. I will explain to you what are they. The balance of it belongs to the ordinary equity shareholders. The those profits belong to the shareholders, but as of now, they are not distributed. Eventually, it would be distributed, maybe in the future years, or even at the time of winding up of the company on liquidation also. Those profits belong to the shareholders. So they are all accounted under the broad category called as equity. Under equity, we see share capital and all undistributed profits. Now, when we look at what are the different types of share capital, there are two types of share capital. One is it's preference share capital. The second one, because there's no preference, it's called as ordinary or common share capital, common equity share capital. There is no preference, therefore it is ordinary. There are two different types of share capital. What are the attributes? What are the features of these types of share capital? Preference shareholders have a preference in terms of payment of dividend. See, multiple times we did refer to the income statement format. Once again, let's look into that. See, preference shareholders have a preference in terms of dividend payment. So the terms and conditions are at the time of issue of preference share capital, what is the percentage of dividend that would be paid to them would be pre-decided. So the share capital will have the percentage of dividend that would be paid also included in the title of the share capital. Let's say 5% preference share capital, 5% different categories, 5% cumulative preference share capital, or whatever are the other features that would be mentioned in the title. So the title will have the percentage of dividend that would be paid on preference capital. And then we see whatever is the balance. I will take you to the income statement. See, from sales minus cost of goods sold, gross profit, and we see all the other expenses, operating, non-operating expenses, non-operating incomes adjusted. So this is the profit that is available to all the investors, both the debt holders and equity holders. The total amount of profit available to the investors. Out of that, outsiders are given first preference, so interest is paid to them. This is the profit available after interest payment. Then the tax calculation is taken up. Earnings after tax is the total profit available to the shareholders. So out of this, the first preference is given to preference shareholders. Preferred dividend is paid. Preferred dividend is paid, and the balance of it, the entire amount of balance of profit, completely belongs to the ordinary equity shareholders. Okay, so first preference is given to preference shareholders, but then again, subject to availability of profits. Profits, when they are available, only then preference dividend will be paid. In case of interest, even if there is a loss at this point of time, even if there is no earnings, it's only loss, also interest amount should be paid. It is an obligation in case of interest. See, even if there is a loss, also interest payment has to be met, but that is not the case with preference share capital. Only when there are profits, preference dividend will be paid. Then what about the years when there are losses and no preference dividend is paid? There is one feature, that is these preference dividends, though that are not paid in the years when there are no profits, these dues can be accumulated till the time when there are profits, and the year when there are profits available, the accumulated dividends that are due would be first settled, and then the balance of the profits will be distributed to ordinary equity shareholders. No such preference is given to ordinary equity shareholders. They would be paid dividend after the dividend to the preference shareholders is paid. Okay, let's go back to the PPT. So ordinary share capital and preference share capital. So first set of preference is given. First set of preference is given to at the time of dividend payment. The second one is at the time of liquidation, after settling the dues to outsiders, all other liabilities are settled. Then in the order of settling the capital amount or repaying the capital amount, preference shareholders then also would be given the preference. After their share capital is paid back, then comes the turn of ordinary equity shareholders. So in these terms, we see that preference shareholders have a preference over ordinary equity shareholders. Then again, under preference share capital also, we see that there are two types of preference share capital. One is redeemable preference share capital and irredeemable preference share capital. Usually it is irredeemable. Share capital is irredeemable. But very, very rarely, there could also be situations that preference share capital is redeemable. That is, there is a time period at the end of the time period, like debt capital is redeemed, debt capital is paid back. So also preference share capital would be paid back. Redeemable, this is rare. Debt is redeemable. It has a tenure time period. At the end of that, debt amount would be paid back. Okay, but then again, there are certain rare situations wherein debt also could be irredeemable. But preference share capital is usually irredeemable, but in certain cases, it could also be redeemable. Okay, ordinary share capital. Ordinary share capital, because if they do not have a preference, then what is that they have? So there must be some advantage even the ordinary shareholders should enjoy. They should also have some advantage. See, ordinary share capital is the share capital that has been issued by the company to shareholders in exchange of monetary value, usually for cash. So what advantage do they have? So if they do not have a preference, then they have voting rights, something called as voting rights, proportionately to the number of shares that they own. Okay, proportionally to the number of shares they own, voting rights would be allotted to them. What do they do with the voting rights? See, whenever the meetings are conducted, wherein the shareholders also participate, at that time, using their voting rights, they can vote for decisions. So in a way, they are participating in decision making. So when they can participate in decision making, they are also managing the company. Okay, so though not completely, but they also participate in the management of the company. So they become the real owners of the company, because they are also participating in the decision making by casting their votes. They become the real owners of the company. Another advantage is, see, in situations where there are super profits, high amount of profits available, all that profit belongs to them. The total amount of profit that is available after discharging all the dues to be paid to investors, that is debt holders, then the preference shareholders. After that, whatever is available the entire amount of profit belongs to them. Okay, so that these are the advantages of ordinary share capital. How do we account for these things? What are the journal entries that we write in the books of accounts? The journal entries that we write in the books of accounts on issue of share capital, cash comes in, cash to capital is a very basic journal entry. The very first entry we learn in terms of writing journal entries. So it's just not capital, it is share capital, cash to share capital. When the shares are issued at a premium, why would the company issue it at premium? Why would the investors buy it at a premium price? What is the reason? Premium is what the face value which is there on the share certificate. See, whatever is the stated value.
Ma'am, because the value of the company keeps on increasing as the profits increase, so that they need to increase the demand for the shares also increase, and the prices of the shares increase to the premium value.
That's right. When the demand
Instead of the
increases, the price also increases. That's yeah. See, the supply is limited. The number of shares that are issued by the company is limited. But when there is a demand seen in the stock market, because the demand rises, the price also rises. Supply being constant. Okay. So why would the demand rise? Definitely, as you have mentioned, the profitability is one important factor. They can be assured of their returns because the company is doing well, the profits are good, and they are assured of receiving their returns in the form of dividends. So that increases the price of the shares, and they are sold at premium. So the premium amount is also a benefit for the company. So cash received as against the total amount that is received on account of share capital at face value and the share premium. That's the journal entry. Now, another type of issue, see another type of the types of issues we see: rights issue, bonus issue. Rights issue is additional shares that are issued by the company. The initial, the first time when the shares are issued in the stock market, it is the IPO, the first time, initial public offering. Eventually, whenever they issue additional shares, it is follow up. So follow on after that, whatever are the shares issued. So when they require additional capital, company can issue additional shares. This time, a rights issue would be about rights issue is the issue of new shares, but they are not offered to all the investors in the stock market. Is not open to public, but these new shares that are issued are only offered to the existing shareholders. Existing shareholders in proportion to their existing the number of shares they own. So proportionately. And another feature of that is it is issued at a price at less than the current market value. One reason is, see, whenever they issue it in the stock market, I mean open market offer open to public. So there are so many formalities that have to be fulfilled. Um, there should be an advertisement given, approach, fulfill the formalities, approach the underwriters, so pay their charges, etc. Um, the prospector has to be printed through advertisement, calling in the investors to come and invest in. So all those are additional expenses. Now, if the issue is to the existing shareholders, those additional expenses need not be incurred. Therefore, it is possible for them to bring down the price, lower down the price, and offer the shares to the existing shareholders at a price less than the current market value. That is what makes it uh, possible for them to issue it at a price less than the current market value. What are the advantages and disadvantages of issuing rights issue? Advantages are cheap to raise finance. They need not approach the underwriters, brokers, etc. Those costs would not be there. Easy, simply communicate that to their existing shareholders and raise the capital. Cheap to raise finance, more successful than selling shares to the public at the market value. So there is also, when there is an issue, there is also a possibility that all the shares may not be subscribed, they may not be purchased by the investor. Then that is, in that case, the underwriters commission has to be increased so that they purchase all the shares. So that makes it expensive. But here, because it is a communication between the company and the existing shareholders, see, if any of the existing shareholders is not interested to take these rights shares or purchase these rights issue or rights shares, they also have the chance to decline that. Then they would be allotted again to the remaining existing shareholders. So that feature is there. It is not a compulsion that the existing shareholders should purchase whatever is allotted to them. They do have the offer of possibility of not accepting the offer. Okay. So it is as simple as that. It is a settlement. It would be settled between the company and the existing shareholders. So it's more successful than selling shares to the public at market value. Disadvantages are in terms of cost. We saw that equity is an expensive form of, it's costlier uh, capital than debt capital. So on that note, it is more expensive than issuing debt capital. That is a disadvantage. Okay. The rights issue may not be taken up by the shareholders, but then again, others may be interested. So that could be allotted to those that are interested to purchase these shares. But otherwise, there is a possibility of the existing shareholders refusing to buy these shares. That can be looked at as a disadvantage. What are bonus shares? So this is also issue of new shares to the existing shareholders in proportion to the existing shareholding. But this time, see, when profits are available and when dividends are to be distributed, cash is used to distribute dividends. So cash dividend, we call it as. When cash has to be distributed, but then that would reduce the available funds that with the company. Therefore, in place of paying cash to the existing shareholders, new shares would be issued to the existing shareholders. So no cash is received. So then shares are issued to the existing shareholders. Shares are given in exchange in lieu of making cash payment. So right as of now, company is not receiving any cash, nor is it paying any cash in the form of dividends to the existing shareholders. It is only that new shares are raised, new shares are issued, and issued to the existing shareholders. Advantages are market value per share is reduced and therefore becomes more marketable. Market value per share is reduced and therefore becomes more marketable. Why would it become less? Market value per share, why would it become less? Um, why would it become less?
Ma'am, as now the number of shares in the market are more,
More.
And
Supply increases. Supply increases.
yeah, the supply
More availability.
increases
Very
and
good. Very good.
more availability.
Therefore, becomes more marketable. So, in fact, actually, when it is more marketable, it is all a cycle. Then more investors get attracted. So once they are attracted, slowly it's kind of a rise in the demand of the shares. So that's an activity. That's a cycle which goes on, and then the price again increases. So that is what actually happens. So market value per share is reduced and therefore becomes more marketable. Issued share capital is brought more into line with assets employed. So more assets can be acquired. So because the cash balance is
Ma'am,
yeah.
is there any limit on to how much extent the company can provide bonus issue of the shares?
No, there is no. The point here is there is nothing like a fixed amount of dividend that should be paid to the shareholders. But why does the company go in for issuing bonus shares? Is only to ensure that the existing shareholders are satisfied, not to cause any kind of a dissatisfaction among the shareholders. So the company goes in for. It is not under an obligation. There is no such limit as such which they have to follow to issue the shares and allot it to the existing shareholders. It is only to ensure that they are not dissatisfied with the company. Something which is paid to them. See, as such, here also we see that a portion of the profit is distributed to the ordinary shareholders. The balance of it is retained. See, even if it is retained, eventually it belongs to them. By retaining these profits, this would go into additional investment. Additional investment will give additional profits. Those additional profits also belong to the ordinary equity shareholders. So when these things belong to the ordinary equity shareholders, more amount of return is available. Earnings per share is high. How do we calculate what is the concept of earnings per share? The total profit that is available divided by number of shares. So profit available is high, but distribution wise, it is not so. Um, so if the profits are not distributed, they are reinvested profits earn additional profits, and that will be available here. Net income of ordinary shareholders again increases, earnings per share increases. So that's profit by number of shares. This would be there, but there is a saying that a bird in the hand is worth more than two in the bush. So more if the attitude of the shareholders is that they want a return in the current period, then they would be looking at some return which is being paid to them either in the form of cash dividend or bonus shares. For that reason the company goes in for, but there is no such limit which is there on bonus shares. So this is number of shares. So each share, how much is the profit available? So these things also, this is one piece of information which is available to the shareholders. It will enhance the, because if the EPS is very good, this reflects in the stock market. The share prices will rise because the EPS is very good. So whenever you see the financial statements that are disclosed, along with that, certain other ratios are calculated and disclosed. One among them is EPS. EPS is calculated and it is displayed, which reflects the profitability position. But some of the investors still do want some return to be paid to them in the current period. To satisfy such shareholders, bonus shares are issued. There are situations where, of course, later on, right now, so it will not be a part of that. But when you study about how, I mean, dividend theories and then what role dividend play in terms of deciding the value of the company. Uh, so theoretically stated, practically what happens is not the case, but theoretically stated, sometimes investors also want the retained earnings to be as 100%. They don't want any dividend to be distributed to them in the current period. These are all theories, dividend theories. Why would that be so? If the company is better earning than what the market is earning or what the market is offering, the company's profits are better than what the investor would be um, able to earn from the market. Okay, then in that case, the investor wants the profits to be retained in the company itself. These are theoretically speaking. But then practically also, when we look at that, some of the investors may want these dividends to be paid. Therefore, bonus shares are issued. The journal entries are share premium to share capital. Remind me tomorrow. I am doubtful about this entry. The journal entry is not share premium, it is retained earnings. As far as I don't know, but I will refer back. My my idea about this is it is retained earnings to share capital. It is not share premium to share capital. But anyway, I will refer that and then I'll clarify it in tomorrow's class. Because any such action that is taken is met out of the retained earnings, not out of share premium. I don't know. Okay, so let's talk about dividends now. Okay, so preference dividends, ordinary dividends. Preference dividends usually based on a predetermined dividend rate. So at the time of issue itself, this predetermined dividend rate would be decided, such as some percentage of the nominal value. So whatever is the face value, the share capital on that, this percentage is calculated and paid, subject to availability of profits. Profits when they are available. So based on this calculation, the preference dividend is calculated and paid. Ordinary dividends. Ordinary dividends, there's no predetermined dividend rate at all at the time of issue. Each year in the annual general meeting, decisions are taken related to what percentage of the amount would be paid as a dividend. The distribution of retained earnings to shareholders. So out of the retained earnings, the amount of dividends, equity dividends, ordinary equity dividends would be paid to the ordinary shareholders. Dividends are normally accounted for only when they are paid. Proposed dividends are not accounted for as a liability. See, if they are proposing to pay a dividend, it is not accounted only when the settlement is there. That is that this journal entry would appear in the book. Out of the profits that are available, these amount of dividend would be paid to the ordinary shareholders. Each year it would differ. Usually we see that there is a growth in the amount of dividend paid, but not so well-to-do or not so profitable companies also may adopt a policy of paying a constant dividend per annum, but the ones which are profitable, they also pay higher amount of dividends because retained earnings are there, growth would be there. So the dividends also grow at a certain percentage, and each year it would be higher than the previous year. But there's no such predetermined dividend rate on ordinary share capital. Another type of capital is debt capital. Debt capital. So what are the different types of debt capital that can be raised? A fixed term loans, a loan note is the document that is the evidence of the debt. Okay, under debt, So we see different categories like secured debts are there in unsecured debts. So secured debts, so these debt holders will have a claim on on any of the assets. So the asset would be um, shown as a security, so they can have a claim in situations where the obligations are not met. So then that makes the debt capital a secured debt, secured loan, secured debt. Unsecured is there's no such claim that they can have on the assets of the company or any asset of the company. Okay. A loan note is a document that is evidence of the debt. At this stage, I think, I mean, even when you study other papers like F9, F9 is completely exclusively financial management. So in detail, the valuation, calculation of cost of debt, different types of debt, all that you will study. This is because it's a basic level paper. Just have to understand about the debt. What's the journal entry? Cash what comes in and long-term liability. So name of that long-term liability, it could be bank loan, it could be loan raised from a financial institution. Sometimes the company also issues bond in the form of bond capital, bond, or what we very commonly know it as debentures. So in the form of debenture is also one type of bond. So that would be written. And annual finance charges, which are interest, um, which is interest. Interest has to be paid periodically. So if it is paid, it is interest or finance charges to cash, or if it is still not paid on the date of um, closing the financial statement, it would appear as a current liability because it would be paid in a short period of time. All undistributed profits which are there as other reserves. We did learn about revaluation surplus. Records the unrealized gains on property, plant, and equipment at the time of revaluing the assets. Any amount of gain that is realized is charged to revaluation surplus account. This cannot be used to, account for payment of dividends. So this is only a increase in the value of asset, which is, see, it is not sold. As of now, there is no realization in terms of, because the asset is not sold, but they have realized a gain. In the case of selling the asset, they would realize that gain, and because the market value is already inflated, because it is all certain that the price is already increased, that certainty is there, therefore it is accounted here as a gain. This is a book entry. This amount, whatever is reflected, cannot be used to account for the dividend payment. Then we have retained earnings, the profits that are retained in the business, not distributed to ordinary equity shareholders. This entire amount belongs to ordinary equity shareholders. Records the accumulated year after year, whatever is not distributed to the ordinary shareholders is accumulated. Records the accumulated total of profits and losses to date. Can be distributed as dividend. So it could be this amount is used to distribute dividends, this amount is used for reinvestment, this amount is used as to meet any kind of contingent liability arising in future. So for all these purposes, retained earnings are retained in the business. And that's why, see, there are four financial statements. Four financial statements. We have balance sheet, statement of financial position, statement of income, profits and losses. That is the income statement. Third one is statement of owner's equity. See, in case of companies, because share capital would not change, it would be there at the face value. Share premium also would be the same. So then we have the changes that happen each year on account of profit earned, on account of distribution of dividends or any adjustments, that would be made to the amount of retained earnings. So in the statement of owner's equity, I don't know whether I have, I'll just run through these slides if it is there. So these amounts are written in column forms. So columnar way, I also don't remember showing, but somewhere it should be there. So in the column of retained earnings, these adjustments are yes, yeah. So equity is a very broad term. Under equity, many items are there. So we have share capital, share premium, revaluation surplus, etc. Other reserves, any purpose which is known and then amount which is set aside is under other reserves. Then we see retained earnings. All of them together is one item called as equity, but they are separated by different columns. The changes that happen during the year are all adjusted as against the retained earnings. So any transfer between reserves appears here, that is set aside and separated for a specific purpose. So it moves from this account to other reserves. So any kind of a payment, any kind of a profit that is earned available, so that gets added. Then the dividend payment is deducted and the available. So the adjustments are made to the retained earnings. The income statement has two sections. One is the income statement and the other one is other comprehensive income. Income statement is comprehensive income, then any other things which are irregular in nature are recorded under other comprehensive income. Both of them together is called as total comprehensive income. Total comprehensive income, that's the profit available during the current year. It is added to this and then deducted amount is the dividend that are distributed and the balance. So that gets reflected here in this column, and then we have the total. Okay, so all of them together, it is only one item called as equity, but the adjustments are adjusted against the retained earnings. Sorry, I jumped to many other. Okay, so that's retained earnings. Next one, tax on the income of a company. The profits that are generated by a company are subject to tax. In the UK, this is known as corporation tax. International accounting standards terminology refers to income tax, that is tax on income of a company. So there's a statement, do not confuse this terminology with income tax paid by employees in the UK. That is, it's a personal expense meant by the employees for their income, but the organization, whatever profits are made on that, when it is paid, it's called as corporation. That we understand that. That would be known as corporation tax. The tax rates are different for individuals. The tax rates are different for corporations. Tax is payable So when it is payable, it is shown as a current liability even before it is paid, because usually it is estimated how much would be the total amount of tax that has to be paid. It is an estimated amount. It can be accounted as a current liability. So it is a payable item. So the income tax charges debited, then income tax liability. When the liability is actually settled, cancel of the liability by crediting the cash, income tax liability to cash. It is a current liability. It appears in the statement of financial position. Income tax charges are part of the income statement. If they have paid excess, a return can be expected. Over provision in the previous year, it would be returned if they have charged higher amounts in the previous year, that can be cancelled off. If they have under provision of income tax, additional amounts can be provided. Income tax over provision, under provision. Okay, now let's see. Control account reconciliations. Control account reconciliations on account of receivables and payables. The customers and the suppliers, whenever the amounts are due, are all accounted. In the initial classes, we did look into books of primary entry. Books of primary entry. At that time, the credit sales are accounted in sales book. The credit purchases are accounted in purchases book. Then cash transactions in cash book. Then we have returns books for sales, for purchases. Other things we have it as other journal. From time to time, then these things have to be balanced. When they have to be balanced, we see that these accounts called as control accounts are maintained. So control accounts, general or total accounts that summarize a large number of transactions, because day in and day out these transactions do take place. So then to summarize a large number of transactions, we see that these accounts are prepared. They are part of the double entry system used to prove the accuracy of the ledger accounting system, to just to balance, because multiple transactions do take place every single day on account of operating activities. Mainly used with regards to receivables and payables balance. Receivables ledger control account. Receivables is an asset, so it will have a debit balance brought forward. But by any chance, if there was anything, if at all, if there is a credit balance that is brought forward, maybe amount was collected from the customers in advance, even before the product is delivered to them. So that would have a credit balance, if any. So additional sales made, anything sales returned. Then as against the sales, if cash is received, so then the bank, it would be credited. If there are checks given and those checks are dishonored, so then it would be cancelled off, bank dishonored checks, any amount of refunds that are made. As against the sales, amount that is collected is bank, not collected is bad debts. Okay. Any interest charged from the customers on account of extending the due date or anything, okay, or dishonoring of the checks. So all that will become due to be collected from the customers. Right? Let's close that. This is receivables ledger account. Similarly, payables ledger account, payables is a liability, so it will have a credit balance. Okay. Additional credit purchase is made, amount is settled, anything which is returned to the supplier, any kind of a discount received. Okay. So payment that is made to the suppliers. Then in that case, preparing a control account reconciliation. So the entries that are posted into these ledger accounts, and then they are again brought into reconciliation statement, balance given by examiner. So they would verify what is accounted for, what actually happened, because the bills and vouchers also would be there. So on examining, if there is any kind of a difference in the amount, that would be reconciled in a reconciliation statement. The reconciliation of individual receivables ledgers balance with control account. So what is accounted for in the control account, what is available in the um, other verification, on verifying them with the vouchers, bills, etc. Then the adjustments would be made in the reconciliation statement. That's with receivables and payables. Now let's look at bank reconciliation statement. I think in +2 also you must have studied about bank reconciliation statement. When there is a bank account of the organization open for taking up transactions, not all transactions can be settled in by cash. So they need to use the bank account, and then use of checks is what is required. Bank maintains a book, okay, and there's one book given to the organization. On presenting, there is a let's see, bank reconciliations are required to explain differences between cash book. Cash book is accounted in the company's accounting department. So they keep accounting for the transaction. Bank also prepares the statement. But both these things are not always on par. Why? Because there are certain transactions which take place known to the organization, which is not aware by the bank. So bank will not make any entry in their bank statements. Similarly, some of the transactions which the bank takes up is not known by the business. Therefore, they do not account for those transactions. Apart from that, there are errors also which are possible to happen, but generally there would be a mismatch between the balances as per the cash book and the bank statement, because both the parties are not always in touch and on par with what is happening. Some of the transactions, like the organization must have issued checks to their suppliers or creditors and all, which the bank is not aware of that. As soon as they issue these checks, there is an entry made by them in the books of accounts. Bank is not aware of that. They would be aware only on the creditors presenting these checks with the bank. Then the bank honors those checks and deducts the amount and makes an entry in the books of accounts. Okay, that is one reason. Another reason could be some of the customers directly approach the bank to deposit these amounts in the bank, which the organization is unaware of that. That's another reason. So when as soon as checks are received by the organization, it accounts for that in their cash book in the bank column. So, but then on presenting the check, the amount will be credited, increased in the bank book in the bank. These are examples and reasons why there would be a difference in that. Sometimes some of the payments that the bank makes on behalf of the business, they would account for it, but that information is not yet received by the business, therefore they do not. These are few examples. The three differences between the bank statement and the cash book are unrecorded items, timing differences, and of course there could be certain errors also that are that happen by any one of them. So in that case, there is a difference in the balance as per bank book and as per the cash book. These differences are to be rectified or not, sorry. These differences are to be reconciled. There is a reconciliation statement. The focus is not to see that who's correct or not, but whatever is, I mean, the motive here is to ensure that the amount that is there is correct. So all adjustments that were made in the other book, okay, would be accounted here. So just to check whether both the balances are matching with each other. So only criteria is if the bank, if let's say from the organization's point of view, from the business point of view, if they are preparing the reconciliation statement, all those that were included by the bank are included, not included by the bank are omitted. It is not about whether it is legally correct or not. It is only to match the balance of according to the bank statement. We are not talking about who's legally correct. We are only adjusting those changes to ensure that both the balances match with each other. That is the aim behind preparing a reconciliation statement. Is it technically correct or not? What is included by them is correct, but they might have not included, so they include that. Uh, what they have not included, if it is included here, it is omitted. Is it wrong? No, it is only to ensure that the balance as per the other book matches with the balance as per their book. That is the intention. From bank's point of view, if we are doing whatever the business has done, it is the same thing is included here according to the bank statement. That is the aim behind preparing the bank reconciliation statement. Of course, format wise, if you have to learn, most of the times the students memorize the format and do that. But I think if you apply the logic, it is very easy to do bank reconciliation statement. Instead of memorizing the format and doing this, that plus minus, and students have their own way of memorizing that. But logically apply that. What was done by them, what was not done by the business, focusing on that and then adjusting that. That is how bank reconciliation statement is prepared. All this until now you have done in +2. So we're going at ordinary phase. Anything you want me to explain more, you stop me. I will take that. See, if time is available, I'm assuming that we would have at least 1 or 2 days time. Important topics, numerical questions, we will solve from examination kit. So at this pace, if we go, we should be having at least 1 or 2 days, 1 or 2 days. Maybe Thursday, Friday will be available, or maybe Friday will be available for us to do numerical questions. So then we will take any important topic and then see how the entries are recorded or anything to do with valuation or something like that. Those questions will take up from the exam. The trial balance, errors, and suspense account. What is suspense account? Students' favorite account is suspense account. Anything doesn't match, they prepare a suspense account and write. What is a suspense account?
An account of future plans.
Mm, no, not future plans. Um, Trial balance is a statement showing summary of all the accounts. The balances at the end of the period are all brought to a statement called as a trial balance. The trial balance is a summarized list of balances from the ledger account. Because it's a double-entry bookkeeping system, um, every transaction has dual aspect. So there's a debit, there's a credit. So one transaction appears once in on the debit side and once on the credit side. So it would be posted into ledger accounts. So ledger accounts are balanced. Any balance that is carried forward is brought to the statement called as trial balance. Because every transaction either is in it is there in debit form, it is there in credit form. So that would come to the trial balance included into any account. It comes as debit as credit. So trial balance should match the two columns of the trial balance should match with each other. The total should match with each other. If everything was done correctly, if there were no errors, if the balances do not match with each other, the debit and the credit, they are not equal. See, for a small organization, again, look into the transactions, verify, rectify, all that, it becomes possible to understand that and then ensure that debit and credit balances match with each other. Sometimes when the volume of transactions are so large in number and then it is not possible that for that difference in the balances between debit column and credit column, it is charged, that difference is charged to an account called as a suspense account. A suspense account arises from errors causing the trial balance not to balance. Okay, so okay. Any balance on the suspense must be eliminated before the final accounts can be prepared. Okay, so until that thing is identified, etc., or whatever way they want to settle. So that should be adjusted. Any balance on the suspense must be eliminated before the final accounts can be prepared. Generally, in the examinations of the students, when they are unable to, if a trial balance has to be prepared, if they are unable to identify the error, so very simply, see, even if the balance sheet also, if they are not able to balance the balance sheet on both the sides, this is one practice of the students that they write, they bring into balance sheet one account called a suspense account, write it and close it. Okay. Now come to the types of errors that take place. What are the different types of errors? Errors where trial balance still balances, errors where trial balance does not balance. Suspense account created. Maybe something was omitted, omission. Okay. Commission, wrong rule followed. Okay. Error of principle, wrong rule followed. It commission is in, Okay, I don't know where I got disconnected. Errors while trial balance still balances. First is error of omission. Here in this case, the first situation is the trial balance, both the sides match with each other, both the balances match with each other, and there is an error. So error of omission, the entry was not at all, the transaction was completely omitted. Okay. Errors of commission is when the accounting mistake happens. It's the there was a mistake made by the accountant while accounting for the transaction. Principles is the rules are not properly followed. Compensating error, in one place there is an error made and a similar type of an error is made to that extent. Another place also the same an error is made to that extent, that is compensating error. Okay. Error of original entry. At the time of recording the entry, at that time itself, when there is an error that is made, reverse, then they are the entry is recorded in a reversal of entry. So in all these things, the trial balance matches with the columns match with each other, but these are the errors that happen. Errors where trial balance does not balance, a suspense account is created. Only one side of the entry is recorded, the other side is not recorded. Then we see the total of debit and credit doesn't match with each other. Same sided entry, both of them are written on the same side. Incorrect addition of ledger, extraction error. So while recording them and posting into the ledger accounts, if there are errors. Okay. So we see two different types of errors that happen when the trial balance matches, the columns match with each other, when the columns do not match with each other. These are the different types of errors that are possible to happen. Write the journal entries and then see that they're posted. Identify what are the errors. Until the errors are identified, the difference in that is accounted in suspense account. But after rectifying the errors that take place, the suspense account would be closed. An account in which debits and credits are held temporarily pending identification and correction of errors. Create a suspense account when the debits and credits of the trial balance do not agree. A bookkeeper is not sure where to post one side of an entry. Next topic. One more thing. Tomorrow I may not take the class. So, if I do not take the class, it would be extended by one day. How do I inform it to you? Did someone now send me a message on WhatsApp? Nobody is responding.
Do we have to send the message?
Did someone send me? I received a message on WhatsApp. Somebody said, "Hi, ma'am. Is it from your class?" One of you? Okay. One of
Not
you,
me,
please.
ma'am. That's for sure.
Is that you? Okay. No, I asked you.
No, ma'am. It's not me.
Okay.
I said.
So one of you send a message. Just say hi. I will send the PDF PDF of the exam kit, and most probably the class would be there. But by if any case I do not take the class, I will inform you. Otherwise, you will keep waiting for me. So one of you be in touch with me on WhatsApp.
Sure, ma'am.
Yeah. So because of the errors and rectification of that, if there is um, any impact on the profit, how do we adjust? If profit decreases as expenses increase or income decreases, so the journal entry that is passed is profit and loss account, because it profit decreases as expenses increase. So charge it to profit and loss account and adjust it against the statement of financial position. So very specifically, it is about the retained earnings. It could be adjusted against the retained earnings or the profit and loss account. Okay. So if the profit increases as expense decrease or income increases, so the profit increases. So it would go to the profit and loss account credited, and then that would be taken to the statement of financial position. It goes to the retained earnings. How are the financial statements prepared? What's the accounting cycle basically? First step is the transactions are journalized. They are posted into ledger accounts. The ledger accounts are closed. The balances are carried to a statement called as trial balance. Trial balance becomes the basis for preparation of final accounts. So the financial statements, terminal statements are prepared. See, after the trial balance is prepared, before the final accounts are prepared, if some of the adjustments are identified, they would not pass through the journal entries posting into ledger account, because it's at the end of the year now that the final accounts are to be prepared. So the effect is directly shown in the financial statements. Dual effect would be shown. So year-end adjustments made in ledger accounts are closed off. Trial balance is used to prepare the final statement. That's the accounting cycle. We know that. The adjustments to the initial trial balance. These are few examples of what are the different types of adjustments. The following adjustments need to be processed before the financial statements can be created. First one is a closing inventory. Closing inventory would be valued as on the last date, but before the last date only, the trial balance would be prepared, because everything to close it on the last date would not be possible. Inventory after the last entry of inventory issue is made, then the inventory value is calculated, closing inventory. So what is the amount of inventory on hand on the last date is closing inventory. How do we adjust? What are the two effects of the adjustment? Where would the where would this amount appear in the financial statements? One effect is
Can you please repeat the?
closing inventory. See, there are certain um, adjustments. The accounting cycle says that first the transactions are journalized, then they are posted into ledger accounts. Ledger accounts are closed, the balances are carried forward to the trial balance. Then the trial balance becomes the base for the preparation of financial statements, final accounts. But even after the trial balance is closed, some transactions would be identified as, and then they would be treated as adjustments. A list of some of the items are given. See, after the trial balance is prepared, then before the final accounts are prepared, when they are identified that these did not pass through the journal entries, ledger accounts, etc., they have to be treated directly into the final statements. One such item is closing inventory. So closing inventory, once it will appear in the trading account as part of cost of goods sold. Second one is, we see that closing inventory is a current asset. So it appears on the asset side. Two effects. So like that, some of the items are given. Depreciation and amortization charges for the year, accruals and prepayments, irrecoverable debts and any kind of an allowance that is created for doubtful debts, income tax, provision liability which is created, any kind of provision or contingent liability, events after the reporting period, anything that arises which has not appeared in the ledger accounts and the balances are not reflected in the trial balance will be taken up for adjustment directly into the financial statements. While the financial statements, the final accounts are prepared, these transactions will be directly posted into the financial statement. Okay, let's see limited company financial statements. Somehow I assume that you are not there on the other end. I'll just explain the statement of financial position. We'll just discuss about this one and then we'll wind it up. Because no response is coming at this hour. You may be tired. Then we will look at statement of profit and loss and other comprehensive income. From then we will look into that in the next class. I'll just explain about the statement of financial position today and we can end the session. One of you be in touch with me. Tomorrow I will let you know if there is a class or not. I'll post a message on the WhatsApp. Okay. The accounting standard, international accounting standard number 1 talks about the presentation of financial statements. We see that a statement of financial position SOFP is prepared, statement of profit and loss account, statement of changes in equity, and the fourth statement is statement of cash flows. Anything which does not appear in any of these 4 statements, that additional information, if it is useful to the users of the financial statements, would be noted down or it would be disclosed in the notes to financial statements. So all these things are to be disclosed and it is mandatorily disclosed by the business entity. So these are the financial statements and the notes to financial statements prepared and disclosed. Among them, the first one is what we commonly use this term called as balance sheet. Now that is also called as statement of financial position. It talks about the financial position in terms of what are the assets the business owns and the liabilities it owes to various parties. Broadly classifying, the assets are classified as current assets and non-current assets. Non-current assets, we see that first item is PPE, property, plant and equipment, and intangible assets. We did discuss about the meaning of these things. We did understand about property, plant, equipment, and intangible assets. Then those assets which can be converted into cash, which can be easily liquidated into cash in a period less than in a period of 1 year or operating cycle, whichever is longer, we call them as current assets. And these are the items. So this is on the asset side. On the liability side, equity and liabilities. Equity is the liability to the owners. Under equity, we have share capital, share premium, revaluation surplus, retained earnings. After that, any liability to outsiders is called as liabilities. That liabilities, if the liability arises in a period after 1 year, it is non-current liability. If the liability arises in a period less than 1 year, it is called as current liability. So we have it as anything which is greater than 1 year, the liability tenure is greater than 1 year, it appears as long-term liability. It is less than 1 year, it is current liability. So trade and other payables, taxation, any other liability like expenses not paid, outstanding expenses, or any kind of an accrued, any kind of a income received in advance. Okay, any portion of the loan amount that is to be paid in the current period, that is a one portion of one installment of the loan amount, if it has to be paid. So that those kind of payments, any provision that is created which has to be met, any tax amount which has to be paid in the next period, these are all current liabilities need to be met in the next period. So in a period of 1 year. So they are not current liability. Together, total liabilities plus equity is total equity and liabilities in the statement of financial position. Okay. Fine. I'll end the session here. We can continue tomorrow. We have statement of profit. What we have under comprehensive income and then certain other things.
Okay, ma'am.
Okay. After a long time, a response is coming. Okay.